Let's bring Dolf van den Brink into the conversation. He is the CEO of Heineken. Dolf, nice to have you back with us on the programme. I mean, is the problem here basically the on-trade business, or is there something more structural with the industry and Heineken at the moment that we need to know about?
Good morning, and thanks for having me once again. No, I think it's a broader issue. Back at the half-year results, when we spoke last, we said that we expected a volatile second half of the year, not realizing how true that ended up being. The third quarter was very good. We were just down low single digits. Fourth quarter with lockdowns all over the world hitting us again, obviously much worse. The year also starting relatively tough in that regard. Clearly, the on-trade globally is badly affected, particularly in Europe, with a lot of countries having the on-trade in full lockdown. But in some countries, it's broader than that. We're just coming out of a full lockdown of the whole market in South Africa, as an example. That lockdown was just lifted first week of February. So it's not particular to it. It is fully dependent on government interventions in containing the virus. Now, what we do believe that getting together, in a bar, in a restaurant, and share a beer is something that everybody is craving. And as soon as we get to the back end of this pandemic, we strongly believe that consumer behavior will come down. It will probably be gradually, but ultimately we do believe it's a kind of a universal consumer behavior, and we look forward to us all being back sharing beers in bars and restaurants because the sector needs it. Obviously, a lot of our customers are hurting in the short term.
You won't get any disagreement to that statement around this desk, I can tell you that much. But let me ask you about the guidance that you've given here, where you talk about the ongoing measures mean revenue, operating profit and operating profit margin will be below levels in 2019. Is this going to be a temporary hit to operating margin, or do you see that reduction in margin lasting longer?
No, so first of all, it will take time to kind of get out of the pandemic. We won't all be, we won't be safe until we are all safe. Now, obviously, developed countries like in Europe, North America, some of the markets in Asia probably will leave the pandemic sooner. We expect that to happen in the second half of the year, but it will take longer for the world before everybody has been vaccinated to a sufficient degree. And that's why we make that statement that, in this year, 21, we don't yet expect to come back to the pre-COVID profit levels. As we speak, we're still being affected.
Dolf, let me ask you about the job cuts. Some were flagged up in the month of October, where we were talking about management jobs to go, given the closures that had taken place in restaurants and bars. Today, it's fleshed out to include around 8,000 people. And just give us a sense of where those jobs are going to come out of different jurisdictions and certain job roles.
Yes. Over our third quarter results in October, we announced a reorganization restructuring of our head office operation, where we aim to reduce personnel costs by around 20%. And then later we extended it to a global reorganization. There's not kind of one generic number. This is really tailor-made operating company by operating company. But indeed, it totals around 8,000 people. We're saddened to have to make this intervention. We postponed it as long as we could. We made a firm commitment of no restructurings in the year 2020, but this year, sadly, we have to start with that. But we do believe it's important and fundamental in making sure that we emerge stronger out of this pandemic and this crisis.
Dolf, let's talk a little bit about what lies ahead then, because I know the analysts are looking for a re-rating of your particular sector as we get back to normal at some point. Do you get the sense that there is pent-up demand out there and that it will translate at some point down the track? And if so, where are you expecting to see that?
Yes, and you saw it in the third quarter. In the third quarter, in most parts of the world, lockdowns were lifted, and you very quickly saw volumes bounce back across the board. In general, for example, brand Heineken did very well last year. Across the board, volume was broadly flat. If you correct for South Africa, where we were severely hit by 3 lockdowns successively, the brand would have grown. The brand grew double-digit in 25 countries across the world. In particular, Heineken 0.0, a big priority, grew in the 30s every single quarter and for the full year. So with all of the bad stuff happening, there's absolute glimmers of hope. There's strong parts of our portfolio that are doing well, with very good and solid performance in a very important market like Vietnam. The Brazil market performed well. It's now the #1 market for brand Heineken, and we grew over 40%. And very important, in China, we grew in the double digits as well. So we do believe that when we get to the back end of the pandemic, those trends hold true and will only accelerate. Brand Heineken, the trend of premiumization, the trend of no alcohol or lower alcohol beers. There's a lot of innovation happening in the sector with seltzers, where we rolled out our Pura Piranha brand in Mexico, New Zealand, and we expanded in Europe. So, as much as we're dealing with the crisis right now, we are very confident and bullish about the future.
Dolf, very good morning to you. Very interesting you mentioned brands there, and you mentioned the premiumisation as well. Have you got too many brands? You've got over 300 brands globally, I believe, that were built up under your predecessor as well. Is it time to pare back a little bit and concentrate on the best of the bunch?
There's a little bit. And that's a never-ending dynamic where there's periods where you really expand and you add a lot of brands and packagings and what have you. And then there's moments that you focus and prioritize. And this is clearly a moment where we are focused on productivity, where we see an opportunity to reduce the number of brands that we support. We're reducing the number of SKUs to reduce the complexity in our supply chain and free up a lot of resources that we then can reinvest in future growth. Because first and foremost, Heineken always aspires to be a growth company, to perform in the top quartile of revenue growth. And, this focus on productivity is really instrumental in making sure that we keep on growing in the future.
I was looking at your CV. You've worked everywhere, haven't you? From Congo to Mexico as well. Where are the biggest growth areas demographically, and where are you finding it a bit of a struggle?
Yeah, obviously beer is still very much a demographics game. So countries where you have good population growth, where per capitas are still low and have good upside. The Brazils, the Mexicos, the Vietnams, the Cambodias of the world. So those are places where we still expect a lot of future growth. Our global footprint, we believe, is one of the strongest out there. It's balanced, it's well diversified, it has the broadest reach, with a lot of embedded growth in there. But it's important that it's a balance between emerging markets, where there's a lot of growth, but also volatility, and more developed markets. That's why we don't stop in kind of investing and strengthening our footprint in these more developed markets. Last year, we made a deal in Australia, where we purchased a couple of cider and premium brands, beer brands, strengthening kind of our operation in that very important profit pool. We did some smaller bolt-on deals in the Netherlands, in Austria, in Europe. So you will find Heineken always kind of focusing on expanding in a disciplined way our footprint to make sure that we capture more growth going forward.
Dolf, thank you very much for joining us today. Much appreciated. Dolf van den Brink, the CEO of Heineken.